You thought divorce was the end of the pain, didn't you? What if I told you it could be the beginning of an even bigger financial nightmare, one that could cost you $100,000 or more? Stay with me until the very end, because I'm going to reveal the critical mistakes that leave countless women over 40 broke after divorce, and how you can avoid them. Mistake 1. Fighting to keep the house. Many women cling to the family home because it represents stability, memories, and a sense of security for their children. But the truth is, keeping the house can easily become a financial trap. Take Sarah's story, for example. She had lived in her home for over 15 years and wanted to keep it for the children. After her divorce, she was responsible for a $2,000 monthly mortgage, $500 in property taxes, $200 for insurance, plus regular maintenance. Within a year, nearly half of her post-divorce income was consumed just to maintain the home. She found herself cutting back on groceries, delaying medical appointments, and unable to save for emergencies. Sometimes, even if you win the house emotionally, you lose financially. Another example is Karen, who fought to keep the house and won, but had to take a high-interest loan just to cover repairs. By the time she sold it 3 years later, she had little to show for her efforts. How to avoid this mistake? Selling the house can be a practical solution. It allows you to liquidate a major asset, giving you cash to invest or stabilize your finances. If you truly want to keep it, negotiate to offset the value with other assets like retirement accounts, savings, or investment portfolios. Remember, your goal is financial freedom, not just emotional satisfaction. Mistake 2. Forgetting the QDRO, Qualified Domestic Relations Order. Many people assume that once the divorce decree says they're entitled to half of a retirement account, the money will automatically transfer. That's not how it works. Without a QDRO, which is a legal document approved by the court, your ex could control those funds indefinitely. Take Maria, for instance. She assumed she would receive her share of her ex's $401K. Years later, she discovered he had rolled it over into a new account under his name alone, and she had no legal claim without a QDRO. The result? Tens of thousands of dollars vanished from her financial future. How to protect yourself? Always request a QDRO as part of your divorce settlement. Work with a lawyer or financial advisor who specializes in retirement accounts. Double-check calculations, account numbers, and transfer procedures. Treat this step like signing over your house, because for your retirement, it's just as critical. Mistake 3. Ignoring joint debt. Even if the divorce decree assigns all debt to your ex, creditors often don't follow the decree. That means if your ex stops paying a joint credit card or loan, you can still be held responsible. Jessica's story illustrates this perfectly. After her divorce, her ex defaulted on a joint credit card. She received collection calls, and her credit score dropped by over 100 points. She had to pay thousands just to protect herself from lawsuits. The solution? Close all joint accounts immediately and refinance loans solely in your name. If that's not possible right away, at least monitor accounts carefully and have a contingency plan to cover any unexpected defaults. This is critical because even small joint debts can spiral into long-term financial consequences if ignored. Mistake 4. Ignoring taxes on asset division. Dividing assets without considering taxes can be disastrous. A $100,000 401K might seem like a windfall, but after taxes, it could be worth only $70,000 or less. Linda thought she was getting her fair share, but after tax calculations, her retirement funds were significantly lower than expected. The key here is understanding the difference between gross and net value. Cash in a bank account is already taxed, while retirement funds, pensions, and other deferred accounts will be taxed upon withdrawal. The net difference can drastically affect your long-term financial security. Avoid this mistake by working with a CPA or financial advisor who specializes in divorce. Calculate tax implications for each asset before signing anything. Compare net values rather than face value, and plan your post-divorce financial strategy accordingly. Mistake 5. Underestimating healthcare costs. Healthcare costs often explode after divorce. Losing a spouse's coverage or relying on COBRA can add hundreds of dollars per month in premiums. Angela, who had a chronic condition, found herself paying $650 a month for insurance after divorce, 3 times what she expected. The unexpected cost wiped out her savings and left her financially vulnerable. To avoid this, research health insurance options well before your divorce is finalized. Check private plans, state exchanges, and any transitional coverage. Factor these costs into your post-divorce budget and settlement negotiations. Even a short-term financial cushion can prevent long-term stress. Mistake 6. Not updating beneficiaries. Divorce doesn't automatically remove an ex from life insurance, retirement accounts, or investment accounts. Emily assumed she had updated everything, but her ex was still listed as a beneficiary. When she passed unexpectedly, her assets went to him, overriding her will. Protect yourself by reviewing all accounts, insurance policies, and investment documents immediately after divorce. Update beneficiaries to reflect your current intentions. This small step can save huge headaches and ensure your assets go where you truly want them. Mistake 7. Settling too quickly. Rushing a divorce to get it over with is a huge mistake. Many women don't realize what they might be leaving behind. One woman, for example, accepted a quick settlement without investigating her ex's business accounts. Later, she discovered she could have claimed an additional $150,000. Take your time. Hire financial experts, gather complete asset information, and calculate post-divorce cash flow. Ensure you understand both short-term and long-term implications before agreeing to terms. Speed may feel like relief, but it can cost a fortune. Mistake 8. Relying only on a divorce lawyer. Divorce lawyers are trained for legal negotiations, not financial planning. Helen relied solely on her attorney and ended up with a settlement that didn't consider taxes, long-term expenses, or retirement. She later had to take on extra work just to make ends meet. Always work with a certified divorce financial analyst, CDFA, or financial planner alongside your lawyer. They provide insight into cash flow, long-term budgeting, taxes, and retirement planning. Combining legal and financial expertise ensures your settlement is truly secure. Mistake 9. Forgetting insurance tied to support. If your ex dies, alimony or child support usually stops unless there's a life insurance policy in place. Laura's ex passed unexpectedly, and her payments stopped immediately. She had no backup plan and struggled to cover basic living expenses. Secure any support obligations with life insurance, nomming you as the beneficiary. This guarantees continuity of support, even in worst-case scenarios. Mistake 10. Keeping joint accounts after divorce. Joint accounts are a ticking time bomb. Monica kept a joint bank account for convenience, only to find $20,000 withdrawn without her knowledge. Her ex had full access until she could legally close it, leaving her scrambling to recover her finances. Always close joint accounts immediately and open new accounts solely in your name. Monitor any remaining accounts during the transition and remove any linked accounts or credit cards. This simple step prevents financial sabotage and protects your credit score. Divorce is emotionally draining, but being aware of these mistakes can prevent financial disaster. Protect your money, secure your future, and take control of your life after divorce. Knowledge is power, and in this case, it's also financial security. Now I am concluding. So remember, the top mistakes involve clinging to the house, ignoring taxes and QDROs on retirement assets, and leaving joint debts or accounts open. Always sever financial ties, update beneficiaries, and secure support with life insurance to avoid future financial shock. Divorce may close one chapter, but it can also be the beginning of true independence. The $100,000 mistake isn't inevitable, it's preventable. You are in control of your destiny, and it can be one that is strong, confident, and beautifully yours. Now I want to hear from you. Which of these mistakes resonated most with you, and what is the first action you're going to take this week to secure your financial future? Share your thoughts in the comments, and let's support each other in this journey to financial empowerment.